You've probably heard of liquidity and you've probably even tried to look for liquidity levels. However, it seems impossible to find the right liquidity level. Why? Because you don't know exactly what liquidity is. In this video today, I'm going to break down exactly what is liquidity, what it does, and how it works, and how to use them effectively. You see, when it comes to liquidity, this is probably one of the most important components of a strategy because this is where most people get stopped out. Have you ever placed a trade and market is going in your direction and then boom, you get stopped out and then it goes right back into your direction? That is you getting liquidity grabbed. Liquidity basically just means money. It's liquid money, standing orders, or placement of trades where people have entered or where stop loss is most likely placed in the markets, and the markets wants to grab all of them out of the market so that it has more money to move with and then continues to go in the direction. Now in this video, I don't want you to be part of that trap. I don't want you to get liquidity grabbed. I want you to understand it, identify it, so that then you don't have to be on the losing side of the markets. Once you understand this, you will understand that patience works alongside liquidity, but also you'll be able to enter trades after all the other traders have been stopped out, and you can capitalize and make money off simple moves. Now let's get into the markets and let me first break down what liquidity is. Before we go in depth onto the charts, I want to show you the easiest way to identify liquidity and how it works. You see, when we go into the markets, we see an uptrend and a downtrend. An uptrend usually goes up like this, and a downtrend it usually goes down like this. Sorry about my horrible drawing. And what happens is we have something called highs and lows, and we can mark up all these highs and lows like so. And funny enough, without even realizing it, you have understood market structure, but now you have also identified something called liquidity. See, liquidity are highs and lows in the markets. See, so many traders like to overcomplicate this and make it so difficult to find, but reality is every high, every low is a liquidity level. Now we need to find out which high and which low is important, because we can mark up all the highs and lows, but if we don't know what's important, we could A, get faked out, or B, we might not be able to place the trade. So for example, if we're on an uptrend, what I like to do is I like to look for the lows. Why do I like to look for the lows? Because the highs have already been hit. For example, this high right here, if we extend the line, you can see it's already been hit. Those orders have already been filled. However, if we mark up the lows, nothing has hit this level. Now, funny thing with price always likes to go back to price where it was before. So for example, if there's a low created, sometime over the future, there is going to hit that level again. And that's just how price works. And that's how we are going to find an opening. So for example, let's say we're on an uptrend, price has created all these lows. We are waiting for price to come down to this level, sweep this level, or break this level, depending on what it needs to do. And then we can make our decision whether we're going to buy or sell. Now, if it sweeps, we know it's going to go up. But if it breaks this level, we know exactly where it's targeting, this liquidity level and this liquidity level. That's on an uptrend. Now, if we're on a downtrend, it's pretty much the opposite. We mark up all the highs because we know the highs hasn't been hit yet. And all we're doing is we can draw a line on these highs. And all we're doing is waiting for price to get to one of those levels. Soon as price gets to levels, we wait and see whether it's going to be a liquidity sweep or a breaker structure. Bearing in mind, I'm going to explain what liquidity sweep is later on, don't worry. Once we get one of those two things, we can then identify whether we're going to buy or sell. You see, most traders, we're trying to find reversals, or we're trying to find the highest point or lowest point in the markets. The thing about liquidity, which is amazing, is, or liquidity in general, is it gives us an opening into the markets. It gives us an identification that, look, so many orders are getting placed at this level. Maybe you as a trader could also look for trades in those levels. Because if you can place trades where everyone else is placing trades, or where everyone else has their stop loss, you're going to win, because majority always wins in this game. However, if you're placing trades where there is no liquidity, there's no breaker structure, or there's no liquidity sweeps, I will explain what liquidity sweep is in a second. If you place a trade during those times where none of those are effective, you're either going to be in a range, which a range is basically when price is just going up and down like this, or you're just going to be literally stopped out in the markets, or you are going to be that grab of liquidity. Now, I don't know if you've ever heard of something called pool of liquidity. Pool of liquidity is basically these lines right here. So if any trader says, oh, I'm just waiting for the pool of liquidity, that basically means that liquidity is money. So if there's a pool of money, that means that a lot of people have orders in that area. A lot of people have their stop loss lying in the area. Soon as stop loss gets hit, guess what happens? Money gets lost, market moves. That's what happens in the markets. Now, we don't want to be those traders that get stopped out. We want to be those traders where the stop out has already occurred. All the early traders have been stopped out, because you think about it, when we have a breaker structure right here, this is the breaker structure, market is going to go up, a lot of people are going to buy. Why? Because market has pushed up. But guess what? Those are early buyers. Remember when I said early in the video that we're going to see how patience and liquidity correlates? Well, liquidity only likes patient traders. You see, liquidity hates traders that will enter too early, because what it will do is the markets will stop them out, the early entries, and then it will continue in the direction it wants it to go in. For me, I've been trading for 5 years and I've noticed this day in, day out. Liquidity sweeps are probably going to be the most important thing that you need to know in the markets. Why? Because there's two things that can happen at liquidity levels: either a break or structure, or liquidity sweep. Now, if you haven't seen the video on break or structure, I have made a video on my channel. Go check it out. But today we're going to be talking about liquidity sweeps. Now, before we go into liquidity sweeps, if you're interested in getting coached by me one-on-one, I've been training for 5 years. I've also taught hundreds and hundreds of traders. I've helped them become independent traders. We are trying to ruin core sellers. We are trying to ruin signal sellers. If you've been in those two industries or those two groups, those are the worst groups to be in. You're going to fail as a trader. If you want to actually learn how to place trades, if you want to literally sit down on your charts for maybe 1 or 2 hours and make a few $1,000s, if you're interested in that, or if you're interested in trading, I'm holding a free one-on-one coaching session. This is only for a limited time. So if you see that link in the description below, click the first link and sign up today, because once that link's gone, that means spaces are all filled and there's no more sessions for my free coaching session. So if you're watching this video, click the first link in the description below if it's still available. Now, let's talk about liquidity sweeps. Liquidity sweeps are going to be one of the most important components of the strategy, because that is the first step of my strategy. Because without a liquidity sweep, I am not going to enter. Why do I not enter before liquidity sweep? Because I don't want to get stopped out before anything happens in the markets. So for example, if we've had a breaker structure, which most traders will trade from, or a trend line break, or a high has just been broken, or a fair value gap has just been filled and we got rejection out of it, most of the time we still haven't had liquidity. And so what happens is, or sweep of liquidity, and what happens is we end up losing that trade because we were the early traders, we were impatient. So how does a sweep or liquidity work? Well, if price is going up and we create a low right here, all we're looking for, and I'm going to draw this in candlestick terms, all we're looking for is a candlestick that literally wicks the low, and then we get order flow pushing towards the direction we want the market to go in. That's how simple it is. And we'll write it down. Liquidity sweeps are just like break of structure. Only thing that's different is the body didn't close, it was a wick. So if you see a wick, because this is what happens in the market, most traders, they will, instead of waiting for the market and reacting, they're going to predict what the market does. And so when the market is like, when the candlestick is like this, and it's basically, let's say for example, the candlestick is going down and is moving up and down on this level, they're like, oh, we're going to get a breaker structure, let's go and sell in a buying market. Remember, the market is going up. But the thing is, when the market closes like this, and we have a wick instead of a body, that's a liquidity sweep. And that means the market is going in the opposite direction of wherever people are thinking that the market is going to go. So this is also a very, very important lesson, because this is where impatient traders fall for the trap of the market's going down. And then what happens is the patient traders that wait for execution, they get the upper hand because they see that, okay, we had a liquidity sweep, and then they start buying. And so what happens is a lot of sellers in that moment of time get stopped out 100% of the time because they were in the wrong direction, or because they're trying to catch an early reversal that just never happened. So when we talk about liquidity sweeps, breaker structures, or even any terminology, you need to always remember trend is your friend. If you do it on the opposite side of the trend, if you go against the trend, most of the time you are going to lose, or you're going to get stopped at break even if you move your stop loss to break even. And what happens if you don't follow liquidity sweeps, or if you don't wait for liquidity sweep? Because most traders, again, what they'll do is they will wait for the market, they'll see that it's a wick, and before the candlestick even closes, they're saying, okay, liquidity. I have had times in the markets where the market will literally look like a liquidity sweep. Let's say it's a 1 minute candlestick. For 50 seconds, it will look like a liquidity sweep. And the last 10 seconds, the market will move, and then boom, it's completely disrespected the whole system that I had and the whole prediction that I had. That's why I have learned as a trader to always be patient and not predict, but to wait for the market to do its thing and react. You need to learn to react. Without that, you will never ever get the correct liquidity sweep, because this is what happens with liquidity sweep. It's either at liquidity level, it's either going to be a breaker structure or liquidity. And I'm going to share with you exactly what it looks like. If we go into the market, now as you can see, this is a very, very wicky market, not really that nice. However, have a look at this. We'll go back actually. Okay, we'll mark up the highs and lows. Let's mark up the highs and lows. So we've got the low right here. We've got a high right here. And look what happens. The first point of contact, we get a liquidity, market goes down. Okay, pretty easy. Look at this. We've got a low right here, high right here. Okay, again, first point of contact is liquidity. What happens? Market goes down. Okay, let me show you more. Again, you can do this activity. You can literally just mark up highs and lows. So lows and highs. Let's just say right here. Again, over here, look, first point of contact. Price goes up, boom, sweep, pushes up. That's why the market goes up. Now here, sweep, that's why the market goes down. But then look, literally, here's another liquidity sweep right here, liquidity sweep, boom. That's why the market goes. And it goes in a direction. Now this high is also liquidity, but as you can see, the first point of contact was a breaker structure, and therefore that's why the market continues to go up. Now another thing to note is it has to be the first point of contact. A lot of traders, they don't understand, like they will wait, especially with breaker structures. I know this isn't a breaker structure video, but I'm trying to give you as much knowledge as I possibly can. When it comes to identifying liquidity sweeps or breaker structures, you need to understand that it's the first point of contact. It's not, okay, the first candlestick was a wick, the next candlestick is a body, so therefore it's a breaker structure. No. Because what's going to happen, and I remember I was actually sharing this on my Discord community today, and I was showing them exactly, I asked them, is this a breaker structure or liquidity sweep? And so many people got it confused. And that's because they didn't look at the first point of contact. So for you, what is the first point of contact? The first point of contact is we draw a line. The first tap of this line is going to tell us whether it's a breaker structure or liquidity. So for example, here is a breaker structure. Here is liquidity sweep. And all the time, I've never ever seen it not do what I'm about to say. Every time price hits liquidity sweep, it goes into the direction it needs to go in. I've never ever seen it not do that. And we can go back in history and we can just zoom out. Let's just go to like this uptrend right here, and you'll notice we have a bunch of liquidity sweeps. Look at this. Boom, liquidity sweep right here. Boom, price pushes up, pumps up. Okay, cool. Liquidity sweep right here. Boom, price drops. Not a crazy drop, but it drops. Okay. Low right here. Boom, look at that. Low, high, boom, low, sweep, boom, price goes up. And it's so easy once you start locating highs and lows. So the step to I'll write a step-to-step guide for you so you actually know. Step 1, mark highs/lows depending on the trend. 2, now I always say go with the trend. Obviously in this examples, I am going highs and lows just even though we're in an uptrend, but predominantly you want to just mark up the lows if an uptrend. So for example, if we're, I'll actually write this down. If we're on an uptrend, it's lows. Downtrend, let me actually do it like this. Lows. Downtrend is highs. This will help you and save you so much time. Second step, wait for first point of contact. That will tell you the story. That's literally the 2 steps. That's it. There's nothing else. There's nothing more. That is the 2 steps. After that, then you react. So for example, let's go here. We are in a known downtrend right here, okay? We're in a known downtrend. So what are we going to do? We're going to mark up all the highs. Okay, cool. I'm going to mark up all the highs. We've got a high over here, high over here. Let me actually remove all the drawings. Okay. High over here, high over here, high over here. And we're just going to mark up all the highs. Another high over here. Another high over here. Boom. Okay, first point of contact. Finally, Marquez had a point of contact. Look what happens right here. I'm going to highlight this so you can see this. Price taps into this level. Boom. Liquidity sweep. What happens? Bob's your uncle. Price goes down. Let's keep going. Let's keep doing it. Highs. Highs. Okay. Boom. Highs. Boom. Lows. Highs. Boom. Again, first point of contact. Bro, this is literally the easiest method. Bro, you can literally just short this and it's going to go in your favor. Simple. Where do we target? We target liquidity levels. Now, how do we use liquidity effectively so that we can have better trades and we can actually get better entries? Now, for me, liquidity is just an opening for me to scale in. I like to use liquidity on the 1 hour time frame. I don't like to, I've tested out the 4 hours, I've tested out the 2 hours, I've tested out the 45 minutes, the half an hour, the 15. 1 hour is a sweet spot. And if anyone tells you anything else, don't listen to them, because 1 hour is a sweet spot, and that's literally going to help you get you to scale in to that 5 minute or 1 minute. Then what you want to do, once you identified a liquidity level, you wait for a liquidity sweep. Once you get a liquidity sweep, you scale into lower time frame and look for your other confluences. Now, if you want to know my strategy, I'm doing free coaching sessions, link in the description below. Once you use my system, you then can target liquidity levels. Now, the thing about liquidity, which is so great, is once you get a liquidity sweep, put your stop loss above the liquidity sweep, and then put your take profit on the next liquidity level. So, for example, if we're on a downtrend, it will be the lows, the next lows. If we're on an uptrend, it'll be the next highs. So, for example, here, we had a liquidity sweep. Okay, let's just say we followed our system, we enter right off this candlestick. Where we put our stop loss above the liquidity sweep. Boom. Where do we put our targets? Well, boom, look, we have these lows right here. We can go back and target these lows, these lows, these lows. And we can keep going. These lows right here. These lows. And again, I like to identify these all on the 1 hour. These lows. We don't have to go all the way down here. We just stack them up. Stack them up. And now you've got a 1 to 5R just based on a simple tool like, or concept like liquidity. It's so simple. So that's how you utilize liquidity, as simple as that. You first identify the trend. Are we in an uptrend? Are we in a downtrend? Then if we're in an uptrend, we look for the lows. If we're in a downtrend, we look for the highs. We mark them up. We wait for price to give us that liquidity sweep. And once you wait for price to give you that liquidity sweep, you then scale in, use your system or the system that I provide you in that free coaching session. And then you go in and you scale in, do what you need to do, and you enter. Once you enter, you put your stop loss above that liquidity level, that liquidity sweep. Then you target the next liquidity and you just ride the trade. Ride it. TP1, TP2, TP3, TP4, TP5, TP6, TP7. Boom. And you can keep going further. I don't know how low. I mean, it never touched these lows, but I mean, these are the lows it hit, and you could just keep moving your stop loss as well, closer and closer until it just stops you out. And you can squeeze out a 1 to 5 on such a simple system like this. It's so simple that so many traders make mistakes on this because you're overcomplicating it. Don't overcomplicate it. And I want you to write this down. Let's actually write down the steps so you don't have to overcomplicate it. Step 1, find the bias. Once you found the bias, step 2, locate the highs / lows depending on the trend. 3, mark liquidity levels and wait for a liquidity sweep. 4, scale and enter. 5, place stop loss above liquidity sweep. 6, TPs will be the highs or lows that haven't been hit. Simple. That is a step-to-step guide, and you leave the markets alone. That's a step-to-step guide. Screenshot this, put it in your notes, stick it on your walls. This is exactly what you need to use to enter the markets. There's no other method. It's so simple that literally once you do this and you get used to it, you'll do it in 30 seconds. It's that simple. And what this does is it ensures you that you have the freedom to do whatever you like, because you don't have to stare at the markets. You can set an alert. This is a little tip that I actually use, guys. I set alerts at liquidity levels. So as soon as price hits this, I just wait for the candlestick to close. Oh yeah, another thing, wait for the candlestick to close, okay? Once you wait for the candlestick to close, then you're good. Now, when you have an alert, you can literally just set an alert, do whatever you need to do, go play football, go to the gym, go read a book, go pray, go sleep, whatever you need to do, go to work. Then, as soon as that gets triggered, go on your phone and then wait for the candlestick to close. As soon as the candlestick closes, you know what to do, go on to the next steps, stop loss above liquidity sweep, TPs on the highs and lows that haven't been hit, and Bob's your uncle. You're going to have a successful trade. Try this out. Literally comment down below if it worked for you. Back test it, try out this, let me know if it works. If you enjoyed this type of content, make sure you like, subscribe, and turn that bell notification on. But other than that, guys, I hope you enjoyed this video. I hope you learned something. Comment down below if you got any questions. I will respond. And other than that, I'll see you in the next video.